April was a month characterised by geopolitical progress and ultimately more stable markets, but also a rising oil price and a lower Aussie dollar. A quick review of the month, some pointers for May, and an update on our view on interest rates. The trade tensions that were distracting the markets in early April have taken a back seat thanks to China offering an olive branch to the US in committing to cut tariffs on imported cars and promising greater protection on intellectual property rights. So whilst this isn't the end of the threat, we maintain the view that more damaging global trade wars are unlikely and that it's best not to overreact to a single Trump tweet. The Syrian airstrikes and related sanctions on Russia also came and went in their market impact, but we are left with a much higher oil price as a result. Brent crude now up roughly 50% in the last year, as the chart shows. This has reminded the market of the primary issue it has to consider in 2018, rising inflation in the US and so high US interest rates. The next US rate hike is likely on June 13th, and beyond there, we'll see how the US economy is responding to the tax cuts earlier in the year. But the corporate reporting season seems to suggest business is in good health, including strong earnings reports from Amazon and Facebook. As a result, the US 10-year bond rate rose to above 3% for the first time since January 2014. The inflation outlook is also very topical locally, with our CPI out last week showing core inflation nudging 2%, so a little higher than last quarter and above the Reserve Bank's latest forecast of 1.75%. This is consistent with our view on official interest rates being on hold through to November, but for inflation to start to edge back into the Reserve Bank's target range, especially with the price of oil starting to bite at the petrol station. The US dollar strengthened as US rates moved higher, which has kept the Aussie dollar under pressure, but just above key support at 75 cents. This still looks like a critical level, and a lower Aussie dollar will also help with inflation recovering. So the Reserve Bank will be pleased the Aussie Trade Weighted Index is down to 62, its lowest level in almost 2 years. Beyond these highlights, local economic data in April was just marginally ahead of trend in terms of jobs growth, business confidence and retail trade, while housing prices are flat and likely to remain soft in most regions. Looking ahead to May, offshore, the progress in Korea will be fascinating, while the key local events should be the federal budget on May the 8th and jobs and wages data the week after. The budget is likely to reveal an improved fiscal position, helped by higher commodity prices and company tax receipts, which should in turn deliver personal tax cuts. Our AAA credit rating should remain intact, given low debt to GDP, but we will see how convinced the ratings agencies are of a credible return to a budget surplus. And finally, stock markets are near the middle of their range from the January highs to the February-March lows. So until we break those highs, they should be treated with caution. It remains a late cycle, risky period for global assets, even though they may have one more surge higher in them, especially with tax cuts in place in the US and on the agenda locally. And that's the market update from Bendigo Bank.